This silver pattern appeared only twice in 50 years. Both times, massive rallies followed. Both times, most people missed it. Now it's flashing again, and big banks are quietly repositioning. What do they know? I spent weeks digging through price data and vault reports to find out. Hit subscribe, smash that like button, and watch till the end. The answer might shock you. The silver market just flashed a signal that appears once in a generation. Deep inside the price structure, analysts spotted something unusual, a specific formation that has only occurred twice before in the last 50 years. It's not a simple moving average cross or a momentum spike. It's a convergence of three rare conditions: physical demand outpacing supply, institutional accumulation hiding in derivative flows, and central bank policy creating monetary pressure. Each element alone means little. Together, they form a pattern. The first time this happened was 1979, right before silver rocketed from $5 to $50. The second time was 2010, months before the metal surged toward 50 again. Now it's back. Trading desks that monitor structural anomalies have flagged it. Veteran commodity analysts who lived through the previous cycles are issuing quiet warnings. The mainstream hasn't noticed yet because the signal doesn't scream. It whispers through data most investors never track. But history says when this pattern completes, the move comes fast. In 1979, the world was drowning in inflation. Oil prices exploded. The dollar weakened. And silver sat quietly at $5, ignored by most investors. But beneath the surface, something was building. Physical silver demand from industry suddenly exceeded available supply. At the same time, large buyers began accumulating metal through futures contracts. Quietly, steadily, central banks, fighting inflation, raised interest rates but couldn't stop the monetary pressure. These three forces aligned like gears clicking into place. The market didn't react immediately. For months, silver barely moved. Then, almost overnight, the metal erupted. Within 12 months, prices climbed tenfold. Most blamed the Hunt brothers for cornering the market. But the structural setup existed before they accelerated the move. They were passengers on a train already leaving the station. The question nobody asked then still haunts analysts today. Was the squeeze manufactured, or did the Hunts simply recognize the same signal now reappearing? 30 years later, the signal returned. In 2010, silver traded around $18. The financial crisis had shaken trust in banks and paper money. Governments printed trillions to rescue economies. Meanwhile, industrial demand for silver surged. Solar panels, electronics, and medical devices needed more metal than mines produced. Large investors quietly accumulated positions. The same three-part structure from 1979 assembled itself again. Like a lock waiting for the right key, conditions aligned perfectly. By April 2011, silver touched $49, a gain of nearly 200% in months. Then came a sudden crash. Margin requirements spiked 5 times in 9 days, forcing leveraged traders to sell. The move felt coordinated, almost surgical. Prices collapsed just before breaking the all-time high. Many called it manipulation. Others called it coincidence. But here's the mystery that remains unsolved. If the pattern was so obvious afterward, why did almost nobody see it forming in real time? Both 1979 and 2011 shared something deeper than explosive price surges. 3 hidden forces operated together each time. First, monetary stress. Central banks printing money while inflation eroded purchasing power of ordinary citizens. Second, physical shortage. Industrial demand exceeding mine supply, quietly draining above-ground inventories. Third, psychological shift. Growing distrust in paper currencies pushing investors toward hard assets. Think of it like a 3-legged stool. Remove one leg, nothing dramatic happens. But when all 3 legs stand together, silver transforms from a sleepy commodity into an escape valve for monetary pressure. In both previous cases, these conditions built slowly over years before the final explosive surge. Most investors focused on daily price movements and completely missed the foundation forming beneath. The real question for today: are these same 3 forces aligning again right now? Recent data suggests something uncomfortable. Money supply expanded dramatically since 2020. Industrial silver demand exceeds supply for 3 consecutive years. Public trust in central banks continues falling. The hidden denominator is assembling once more. Today's silver market displays the exact architecture that preceded both historic moves. Physical demand hit a record last year. Solar panels alone consume 20% of global production. Electric vehicles need triple the silver of gas cars. Meanwhile, major mints report shortages. The U.S. Mint rationed silver eagles. London vaults show declining inventories. Paper silver trades 500 times more than physical metal exists, a leverage ratio matching 2011 peaks. Central banks printed more money since 2020 than the previous decade combined. Inflation officially dropped, but grocery bills tell a different story. Large buyers are moving. Warren Buffett's Berkshire bought stakes in silver miners. Chinese imports doubled. JP Morgan accumulated the largest physical stockpile in history, over 700 million ounces. The setup mirrors previous patterns with disturbing precision. Yet mainstream analysts dismiss silver as a relic. Financial media ignores the metal. This quiet period feels familiar. Both previous times, silence preceded the storm. The smartest money moves in shadows. Commodity trading advisors just shifted their largest net long position in silver since 2011. They're not buying headlines. They're buying futures contracts months ahead. Chinese state banks imported 4,000 tons of silver last year, triple their normal purchases. India's imports jumped 40%. These aren't retail investors chasing momentum. These are institutions positioning before the crowd arrives. Here's what makes analysts nervous. The accumulation pattern matches both previous setups exactly. Large buyers absorb supply without moving price. They use option strategies to hide positions. They buy physical metal through shell companies in Switzerland and Singapore. JP Morgan's massive stockpile raises questions. Why would a bank hold 700 million ounces unless they expect significant repricing? Delivery requests on COMEX futures hit multi-year highs. Someone wants real metal, not paper promises. The timing clues hide in their behavior. When giants move this quietly, this deliberately, they see something coming that retail investors haven't recognized yet. The evidence creates an uncomfortable picture. We have the same three-part structure from 1979 and 2011. Industrial demand exceeding supply, monetary expansion reaching dangerous levels, institutional accumulation hidden in plain sight. History shows what happens next. Violent repricing that catches everyone off guard. But here's the unfinished equation. This time feels different. The leverage is greater. Paper claims on silver dwarf physical reality by ratios never seen before. Central banks face impossible choices between fighting inflation and preventing collapse. Digital currencies add new complexity. If silver breaks free like previous times, the move could exceed historical patterns. $50 becomes a checkpoint, not a ceiling. The timeline remains unclear. These patterns can simmer for months before erupting. But once momentum starts, containment becomes impossible. Markets have short memories. Most investors forgot what silver can do when structural forces align. They're about to remember. The third occurrence of this pattern may not just repeat history, it might rewrite it. The trail of evidence leads to one destination. Silver has constructed the identical framework that preceded its two most explosive moves in modern history. Every indicator, from industrial deficit to monetary stress to institutional positioning, mirrors the past with mathematical precision. The market doesn't care that investors aren't paying attention. It doesn't need permission to reprice. When this pattern completed before, those who recognized it early protected their wealth while others scrambled for explanations. Now we stand at the third occurrence. The smart money already moved. The physical metal grows scarcer. The paper facade shows cracks. Time becomes the only unknown variable. Will it be weeks, months, or quarters before the pattern completes? History suggests when it happens, the violence of the move will shock even those who expected it. Silver remembers what most have forgotten, and memory, in markets, eventually becomes destiny.